So let's look at something that I'm doing on my next piece of research is looking at corporates around the world. And I have been now to China and India my last 12, 18 months looking at what's happening on the corporate venture side. I've done this now for 10 years, but this is going to be looking really stunning. One part is, this is just on clean tech. One example is on clean tech financing. And if you look at corporate participation in US, Europe, Israel, and China, you can see, so 12, 13%, these are the red numbers. And then you see clean tech. Clean tech seems to attract more corporates. And why is that? Typically, there are more corporates in clean tech rounds than there are in all other rounds. And the reason is, that's very interesting. We looked at this. The reason is because the corporates don't only use the technology to either leverage and sell or use for themselves. First of all, they have a need to clean up. Many of them have a need to clean up their own mess. Okay, that's one. It's true. And that's good. Why not? Number two is many traditional companies are adding a sort of like a clean tech service or something to it. And they're willing to buy those, call it .com related or internet related or mobile related type of companies. That's a new phenomenon. A very traditional industry player without any previous investments into startups suddenly do a number, not too many, but you know, if each of the corporate takes one or two investments, that ends up in a fairly substantial number. And so, so that's basically a sort of, when you look at the Israel again is usually in general quite high in general because it's a tech play. And lots of corporates have set up their offices also in Israel to access those companies. And China, I'm expecting, you see the first 3 quarters, suddenly we are up on 18%. And I think China, I'm telling you, I just came from Tencent, Baidu, Alibaba, Huawei, and ZTE. Those 5 top players. Sina, I didn't visit this time. And I'm assuring you, when I'll show you the next few data sets, this is pretty stunning what's going to happen in China. I really like China from the dynamics point of view, what's changing there. It falls right into my development model. It doesn't matter. This is almost a replicate of the VC investments around the world, except that if you look at the corporates in US and in Europe, they still like the product development and they like the revenue play. It's almost the same picture as I showed you in venture capital, right? So that's almost an identical one, meaning the Westerners like product development and revenue, while the Chinese, again, are into product development and profitable companies by any dimension, right? And I'll show you a result as a result of what that means. Oops. If you look at absolute numbers, here we are. Look at this. In a real startup phase, where you and I have a cool idea and start a company, we get a corporate in very early. It's quite rare, but we are talking in US about 6, 8, 10, 12 deals. That's not much. Forget about it. It's almost nothing, right? But you can see 175 to 120, 130 deals in the US is quite a lot. Participation of corporates. Even more though, 200, 150 to 250 in this space. That's where the corporates in those two sectors can really add value. And even if this looks big, it's only 10 to 20 deals in a profitable stage. Okay, so that is really where the reality is, and that's pretty healthy. I actually like that picture quite a bit. And what that means is corporate, where do they invest in? And you can see in IT, healthcare, and clean tech, it's almost similar to the VC picture kind. A bit more healthcare, life science, specifically in the medtech sector, that's globally actually quite strong. If you look at where corporates invest in China and in India, then you can see again, it's amazing amount going into service, consumer service and business and financial services. That's really where the play is. It's dramatic out there. It's even worse. And you think corporates would go after tech? No. So you also need to understand in China and in India, today, 90+% of all corporate investments are done by foreign VCs. So I'm coming back to what happens to the local VCs. And that's where the story is going to change dramatically over the next 2-3 years, I can assure you. What's the difference on valuations? Pre-money valuations between pure VC, which is in blue, and then when corporates are involved. Now, why do the picture in US and in Europe, why is it so much higher when corporates are involved? The reason is, first of all, if you just take a median, I don't have the time now to show you all the slides about stage by stage. And you will see that the reason this looks so much higher, corporate VCs go much less into the early stage, really into startups. And they go even less, though, into profitable companies. So, but anyway, what that means is, too, because they invest around a certain size of the company, the average is quite high. VCs go in earlier stage too, so that brings the median down. But I did a sector by sector, stage by stage analysis. Western corporates are willing to pay a premium because that has strategic value to it. So that is why typically it's higher. So I can go forever on this. But if you look at one thing, the 2010 data on China is, for the first time, I need to go really down on every single deal because I got this number over the weekend. I cannot imagine, there must be 1 or 2 deals either skewing the picture or the data is wrong. But what I'm trying to tell you, what's most amazing, and I think that is the story you need to understand, is look at this. When corporates are involved in China, the median is lower than the VCs. I go like, whoa. So I went to see all the top guys in China, the Western VCs and the domestic VCs, are just corporate VCs, okay? And I asked the question, why is that? And the corporates gave me a stunning answer I never thought of, right? In the Western sense, they say, well, it has a strategic value to us, and if I get this, I can do that. In China, it's very different because it's a late stage play. A lot of VCs are not operating VCs. They're actually financial VCs, like in many countries, probably almost also like in Singapore. And that means the VCs do not add in the early stage company that much value. Or when it comes to the late stage technology development and going to the market, that's where the corporate really have a big impact, right? And so the corporate VCs in China gave me a stunning answer. They said, we can add much more value than a VC. Why should we pay a premium? Which get the discount, right? And that really blew me away. I thought it through. I said, damn right. I didn't think of it myself when I looked at the data. I thought it was wrong. No, actually it was right. So that is a very interesting phenomenon. But because the VCs on top of it, they're almost equal, VCs don't invest a lot in pre-revenue either, and corporates don't do either. So they invest just in the same stages. That's why you don't see a difference in the first place, and they're not willing to pay a premium in the second place. Right? That is really the answer to this. I've always been asked and said, a lot of investments by corporates end up in acquisitions. So some of the entrepreneurs are really scared to get a corporate in. What stage do I take one in? Should I take one in, yes or no? And so the answer is, let me figure out, I've done US and Europe very in-depth for many years. Let's take the US as one example. In IT, healthcare, business and consumer services, of all the acquisitions happened, let's take the top one, in IT. Of all acquisitions which happened in the IT space of venture-backed companies, what percentage of those companies did have a corporate investor? It was about 30 to 40% all the way through. I thought, okay, that makes sense. And then you can see the other sectors. Then a lot of people argue and say, you look at Cisco, they invest early, and then their strategy is, let's go and acquire them. That's one extreme. You have the absolute other extreme, which is more like Intel, with a large staff on ground around the world, doing massive investments. You will not believe it. How many? They're always top 10, top 5, top 10 any given year. And so what happens is that entrepreneurs are scared. But Intel, yes, they do acquire a number of companies, but the sheer amount they do, it's a very small proportion in contrast with Cisco. And so I wanted to know really on a global, or in the US scale and in Europe, So what's the real reality? What percentage of startup get acquired by a corporate who also invested? That's the key point, right? And if you look at, it's only 1 to 6% at any given year in the previous year. So it's a smaller number, even if there may be other corporates who will acquire them at the end because they have a strategic fit. Right? That was very interesting to see. But actually, the investor really investing and acquiring the company was a very small proportion. So, economic impact outlook. I want to show you just those two slides. Stunning. I don't want to waste a lot of time on it, but if I take the US alone, you can see that 90% of all jobs in US today in software, whatever is left, not in India or China, has been initially financed through venture capital. That's an entire industry almost. Think of it. Look at the biotech, 74 semicon, 72 computers, 54 telco, 48%. That means almost 50 to 90% in those sectors of all the jobs created originated by a venture finance company. Don't underestimate this. A lot of governments, when I speak to them, say, you know, Martin, the VC industry is very small. I say, yeah, but you don't understand the impact it can have. So I'm showing those slides, and they go like, whoops. And the same on the revenue side. Look at this. Anywhere from 40 to 88% is the revenue generation today. Yes, they're public companies today, but they were originally financed through venture. I think that's a very important message to understand. That's why I think it's really important to understand what Singapore could or should do. Europe is even far from it as well. But it's an important message to understand. Talking about creating global leaders, okay? Truly global leaders. In wind turbine, look at this. 1, 2, 3 are Chinese. Then you have the Europeans and then Indians, Suzlon in India. They are the top wind turbine manufacturers. You look at the PV cells producers, the majority driven again by China, which is not a tech play. It's a pure investment and manufacturing play. But just that as a little side note to see that all of them were venture financed before. Or were venture financed. And so that's really important to understand. You can create truly global players with venture financing. And I think one of the discussions we can have, how good is Singapore on creating global leaders? Right? When I look at all the investments and government policies and great stuff done, I'm going to push a bit the envelope. So, last two slides. Very quick. What's the trends? I have a global trend and a China trend, which translates a bit into India. India trails in a number of dimensions China in the venture space. It will get there. I've done the math on it, but it's a good example, and India is going to be to some degree following with some delay by 2 and 4 or 5 years, depending on the sector. So it's a great play for VCs to be in because it's a high growth market. Number 2, China will reach second this year as an individual country behind the US, even if it's a huge distance, but they're actually outperforming any of the other countries around the world in terms of investment amounts invested. You will see more and more pre-revenue and technology plays coming up and moving into second-tier cities now, second, third-tier cities. That's really what's going to happen in China right now. And so I said they're going up. Remember at the beginning my slide? They're going up into the next level. Thirdly, I just spoke to corporates. I mentioned those corporates. I'll leave a word with that quick. The internet and mobile and consumer-faced solutions, applications, products, and services in China are moving so fast that even a Baidu, Tencent, and Alibaba, they cannot keep up with in-house R&D. And for the first time, you will see this. They will start increasingly investing into pre-revenue companies, which they never did, almost never did before. And next year, you will see the major first acquisitions happening of pre-revenue companies from those players. Because it's so competitive. They want to have to be out next with the next feature, the next piece of technology to serve the customers and stay ahead of competition. So you will see a massive play in there. Super angels, I have no time on, maybe later on I will explain that. Super angels are coming up super big time in China, I'm telling you. I was stunned. 10 guys get together, everyone did at least one startup which exited on NASDAQ. 2 guys did 3. They're all an angel group of 10. Very close deal. And they only do service. Another group only does technology and 100% pre-revenue. I love it. That's really moving the needle. Corporate VCs investment, as I said, and M&A will pick up. I still believe 4 years ago, when I spoke to the foreign VCs, said we will have no R&B fund and so on. There's almost everyone now having an R&B fund, or the next fund will be at least a parallel fund in R&B. And then a good mix of foreign and local VCs. I'm battling in the Chinese government. There are two camps. Some of them love the foreign VCs, some of them hate the foreign VCs. They say they eat up our breakfast, whatever. And I said that's wrong. Look at Israel. Any given year in the last 15 years, it was always 45 to 60% were foreign investments. So there's a coexistence of both. And thanks to the foreigners who's killed VC China, it really has impact now. Okay? So don't underestimate that. So I have to be sometimes a bit. So China is really scaling up. It's maturing, and I'm coming to my last slide. I'm probably 2-3 minutes behind, but I'm trying to, these are the global VC trends. The Western VCs who focused initially technology only are realizing there's also, besides technological innovation, business model innovation. And if you look at the best performing companies, ideally, it's a combination of a great technology play with a combined business model play. If you have that, that's a fairly good killer app, right? A combination of both. I have looked at one other prediction I'm having. I just finished the Global Venture Report, which I hope to be distributing through the university and also through the Venture Capital Association. It's the 9th Global Venture Insights Report of Ernst & Young. And I've done this now for the 9th year. And I'm focusing a lot on the emerging markets, on the one coming out in February. And I believe emerging to emerging is a key play. Meaning what? You have high growth nations which have headaches in the hinterland, headaches in the super high growth cities, urban areas. And they have problems we don't know in the Western world, seriously. So how can we find a solution if we don't know the problem? And if you send a Swiss in or a German, it's going to be a Mercedes or a Swiss whatever high-end precision that no one can afford at large scale. That's a bit of my challenge. So I believe the next generation solutions in those high growth urban areas and in the hinterland to fix has to come from local players. And they scale it. China and India really can scale this, trust me. They can scale it domestically. And when they go international, they have economies of scale. The same solution with some adoption may be used in another emerging country. I truly believe, watch out that. I even believe no one looks at China-India interplay today. I think I'm advising a lot of VCs, have a look at this. And the other one, again, I mentioned the angels in the emerging markets. And then technology companies have to go regional and global from day one. And that's even true increasingly in China and in India. Okay? Now, everybody will argue in this room that Indian companies go more international than Chinese. I've done the math. It's only marginally better, trust me, in terms of technology companies. Very marginally true. So we can have a discussion later on this. But for Singapore, we'll have a discussion probably, hopefully here. Switzerland, I'm a Swiss. Trust me, if you are a Swiss startup and you don't have a truly, not only European, a truly global angle, don't even go. Don't go for it. And I sometimes think in Singapore, they have a hard time to go beyond Malaysia. So local VCs, corporate VCs in high growth economies, I mentioned this just before, that will happen more and more. Even Westerners going to acquire Chinese and Indian startups. You will see this come up. They need to access the market. It's not the technology, it's business model and people. Asia is surpassing Europe this year. Russia is the largest untapped technology play. I bet on Russia, trust me. I've been there since the 80s, and I'm going back and I will have my first data next year on the Russia venture. It's still very emerging, but what China and India is for American and other Asians for outsourcing, Eastern Europe is a great pool for startups in Europe and even other corporates to tap into. You go to Intel, ask the question where the highest algorithms are being done. That's not in Silicon Valley, it's not in China, not in India, it's all in Eastern Europe. You look at Romania, Bulgaria, Ukraine, you will be stunned. I just was actually in India and I was spending a few days in a global startup. And guess what? I would have expected only Indians in there, right? No. All the senior top programmers came from Eastern Europe. They were much, much superior, trust me, because the very top guy go to investment banks, right? So Eastern Europe is the major outsourcing for Europe. Globalization of VC will continue. By the way, in US and Europe, it's over 50% of all VCs in terms of numbers. There are about 900 surveyed, have investments overseas. It doesn't mean they have an office, but investments overseas. That's very interesting, right? And that is substantially increasing. I track this every single year. Oops. And unfortunately, that slipped a bit down. It's all too easy to identify the things that might go wrong with an investment. It's far more difficult to identify what might be possible. I think that's a real good thing Singapore should remember. Right? Michael Moritz from Sequoia. So with this, I'm sorry I took a few more extra minutes, but I'll jump off from here right now. Thank you.